What is trading in its simplest form? Trading in its simplest form is just a pattern recognition numbers game. What do we, as technical traders, actually do? We use market analysis to identify the patterns, define the risk, and determine when to take profit. The trade either works or it doesn't. In any case, we go on to the next trade. If we were to picture a process of trading, it would therefore look like this. The arrow represents the process of trading. Every trade starts with a condition, a rule that a trader demands to be present before he can proceed to the pattern recognition stage. If the condition is not present, a professional trader has no trade. We all know that pretty much anyone can get a couple of winning trades, but eventually an inevitable losing streak comes, and for most traders that streak is fatal. Until they learn that in trading it is paramount to minimize losses, because only by minimizing losses a trader can monetize his winning trades. What then professional traders do to protect themselves from taking bad trades that take away their profits? They set rules for themselves, strict conditions that have to be present in the marketplace before they can look for a trade setup. But what are these conditions? Conditions come from studying why patterns fail when they fail, and why they work when they work. The most successful traders found that their patterns fail when they trade against the higher time frame trend, and they win when they are in line with the higher time frame trend. In other words, the lowest risk trade with the highest probability of success occurs when you're buying dips support in a longer term uptrending market or selling rallies resistance in a longer term downtrending market. What then is the difference between a struggling trader and a consistently successful trader? A consistently successful trader has a precise way of determining higher time frame directional bias. He has tools that help him determine where the market is likely to trade to next, and or where is the market likely drawing to. The inner circle trader revealed that the market is always drawing to either an old high and or an inefficiency above the current market price, or an old low and or an inefficiency below the current market price. Until a professional trader knows where the market is likely to trade to next, he doesn't, under any circumstances, engage the marketplace, because he understands and knows that the risk just isn't worth it. Rather than risking his hard-earned money on a 50-50 gamble, he is patient, and he demands that the condition is present in the marketplace that tells him where exactly the market is likely to trade to next. The second the condition is true, he proceeds to the pattern recognition stage of trading. At this stage, the trader drops into his execution timeframe and starts hunting for his pattern or a setup that will allow him to execute on the trade idea. It is paramount for a trader to know in advance exactly what sets your trade up. What does it look like in price action? For this stage, the trader needs to define a precise way of identifying support and resistance patterns, and until his pattern of choice doesn't materialize in price action, the trader doesn't do anything. He patiently waits for his pattern, and the second the setup presents itself in price action, he proceeds to the execution stage of taking the trade. At this stage, the trader determines his entry point, his stop loss, and where he will take profits. That allows him to define the risk as well as the potential reward. If he is satisfied with the potential reward, he sends his limit order into the marketplace. If the reward isn't worth the risk, he waits for another setup as long as the conditions continue to hold true. If the trader decides that the risk is worth it and he enters the trade, At that point, the trade either works or it doesn't. In any case, he goes on to the next trade. Professional traders know that individual trade outcomes are independent and random, but over a series of trades, they produce consistent results. That is why professionals trade in sample sizes of 20 trades or more. They think in probabilities and judge the viability of their edge based on the results of at least the next 20 valid trades or more. In other words, they determine their success on the results of their valid sample size rather than on a trade-by-trade basis. Here's an example of following this trading process. I personally use monthly, weekly, and daily charts to determine where the price is likely to trade to next. As you can see, we determined that price is likely to trade into the daily relative equal highs, to the daily old daily high, and after that reach into the old weekly high. We determined where we want to be a buyer, and as soon as price trades into our buy area, our condition is fulfilled, and this allows us to drop into our execution time frame and start hunting for our setup to execute on. Price does that here when it trades into the daily bullish order block, as well as into the optimal trade entry levels below the short-term daily low, into the daily inefficiency, and into the weekly rejection block. As soon as that happens, we can drop into our execution time frame. In this example, we would use the 1-hour chart. We wait for our pattern to materialize in price, and as soon as we spot it, we determine our entry and stop loss, which gives us the risk, and because we are trading in the monthly, weekly, and daily direction, this allows us to set our take profits based on longer time frame trends. This way, our risk is minuscule compared to the potential reward. We are willing to take the trade. You can see how the trade worked out. We got the higher time frame conditions as we determined where it is best to enter to get on board the higher time frame trend. We waited for our setup to materialize itself on the 1-hour time frame, and we executed our trade there. After that, we went back onto the higher time frame daily chart to look for best possible exit points. We can see that our last exit would have been at the symmetrical price swing from intermediate term high to the intermediate term low. That exit would give us a 22.69 risk to reward, and at that point we would want to be out of the trade. In the next video, we will take a closer look at each of these stages as I share my personal step-by-step process while going through each stage. Please don't forget to like, comment, and subscribe so you don't miss our next upload.